Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to Mark Chadwick of Dowgate Wealth, one of the UK's finest investment houses. So welcome, Mark.
Thank you very much, Paul. That's a very, very grand opening. Yeah, one of the most fastest upcoming and finest.
Fastest upcoming, okay. Well,
yeah,
exactly. I've got a pretty tricky first question for you here. Given the sort of like the nosebleed inflation levels, the cost of living crisis, and central banks tightening just about everywhere other than China, what's your sort of outlook for equities?
It's going to be tough, and it feels like the market is now. We've had a little bit of a rally in what was a bear market over the summer, and that actually came to an end quicker than I thought. I thought the rally would carry on at least into for another couple of weeks. And it feels like we're going to test the lows again. I mean, the small cap market is down. I think at my last count, it's down about 18% this year. AIM's down 24%. So there's a lot of news, a lot of bad news already priced in. But as we both know, bear markets, when things get bad, they tend to get, it tends to go so much further on the way down. So yeah, with the fund, we've gone pretty defensive. We're just over 10% cash in the funds, and we've tried to position it as regards some more defensive stocks, and we've got quite a high position in exposure to the gas stocks. So we've got Kistos, Serica, which are both based here in the UK, and then Diversified Energy, which is listed here, but the assets are in the US.
Yeah, okay. Well, do you want to actually just before we sort of like continue with the macro, you mentioned it, the Kistos Serica has obviously been big news with all things small cap, both of them trying to make a hostile bid for each other, which is unusual, especially where you have sort of common shareholders like yourself, sort of like trying to get them to actually talk. What's your sort of view for Kistos? Because I've been following it for a couple of years, and it was always really cheap. I think it's sort of like its exec chairman is a real entrepreneurial industry veteran who's doing a great job, and the shares have performed fantastically over the last 24 months. They're up about £5, I think they are, from about when they listed about 150. What's your sort of latest on the Kistos?
Well, actually, they listed at £1, but then that was only a small raise, and then the big fundraising was at 155, as you say, was last year, maybe March last year, and we did that for clients. And we backed that because we knew Andrew Austin from his Rock Rose Energy days, and we'd done very well for clients in that. And we're great believers in backing management and people who entrepreneurs who you've done well with previously. You can usually and I say Giles Hargreaves was always very keen on that, and we've followed that through as part of the same investment philosophy. So yeah, we took part of that at 155, and as you say, they've been huge, right place, right time. They've been huge beneficiaries of what's over the Ukraine conflict and gas prices. And I mean, if anything, the two of them bidding for each other has highlighted how cheap they both are, and how much cash they're kicking off.
I just saw Kistos, but it's still on a valuation, I think, for next year, which is less than it is for this year, but it's on a PER of less than 5.
Yeah, exactly. So yeah, so that's the largest holding in the fund, and I mean it's volatile. I mean, they got to probably 640, I think 660 was the high the other week. But then they've sold off quite heavily after when the gas price came down last week, but they're up another 7 or 8% today, and that's one where we're happy to hang on. To hang
and then
on
just stepping back to sort of the more broader picture, let's just assume the sort of eventually, I mean, hopefully, fingers crossed, we'll sort this Ukraine-Russia sort of like crisis out, or it'll at least become more manageable or in the rearview mirror. If we can sort out pandemic, we hopefully should sort out the Nord Stream 1 at some point in time. So just sort of taking a step back, are investors, in your view, after sort of, you've been in the industry over multiple recessions and cycles and stuff, is there a danger that investors are talking themselves into a more severe recession? Because you sort of like recounted a few figures of year to date, but I mean, the small cap, for instance, is off over a third since its highs of just over a year ago. And I mean, that is just, I mean, that's more than bear market territory.
It is, and there's a few things that have happened because of that's because retail investors have pulled a lot of money out of UK small cap funds, and I've got the figure a couple of weeks ago, and I think there's about £1 billion gone out of retail funds, and so obviously the panic really started in February of this year. And then it's fed on itself, and now market makers are unwilling to take big positions on their books. Anything that slightly is disappoints on earnings is getting whacked. But then also anything where there's a few retail sellers, as I say, the market just clears out the way, and things can be down between 5 and 10% on a few scrappy sales, and that then feeds on itself, and then the funds and then what we've had is there's 2 or 3 very large small cap funds here in the UK, and then you've then had them having to move into try and liquidate some of their positions, and they'd historically there'd been a bit of crossover in some of the individual stocks that they've held. So yeah, look, I think that we've not quite reached the point of maximum pessimism, but I don't think we're far away. As you and I both know, equity markets look 6 to 12 months in advance, and the market is now pricing in a recession. How severe a recession, I don't know, but I would imagine it's going to price eventually. If the carries on the way it is, it's going to price in a very severe recession, and people then start throwing the baby out with the bathwater, and that's when you can really pick up some bargains in the small cap universe. Where people just, you have just that point where people just will sell anything at any price, and that's when hopefully where we can really take advantage and actually move in there and actually take advantage of that.
Yeah, I mean, I think having a nice sort of like a hefty 10% plus cash balance, plus a sort of like some stocks are doing quite well, gives your portfolio overall a bit of resilience. Now, just in terms of sort of like deploying some of that cash, I did notice you got some new positions, and can we start off with Wilmington, which is, I think it's an online sort of information data analytics sort of trading platform for financial and for healthcare sector, so for regulated areas. Yeah.
And so we saw that as being relatively defensive because of the sector it's in. The last trading update was very positive. They've got good momentum in the subscription business. We're going to get more visibility in the results in September, so we'll have a better idea as to how things are going. We saw that the new management team has really rationalised the business, and their focus is on the sort of 14 individual businesses. So yeah, I mean, we just thought it's a good place to park. It's not going to shoot the lights out, but it's a good place to be able to park some cash and
it seems to have good barriers to entry because its sort of EBITDA margins are roughly around about 22%, which means that it's got sort of like one economies of scale on that platform, and therefore stops new entrants sort of coming in, doesn't it?
That's right. Yeah.
Yeah. Another one with good drop through rate, which you boosted bought, was Tribal Group, which is again a sort of software. That's platform
software exactly
for universities.
For universities, yeah. And yeah, a new colleague of mine had mentioned we should look at that. And
not from Hargreave. Sorry, Hargreave Hale at all. Or
no, he wasn't from Hargreave Hale. No.
Oh, okay.
And so yeah, I mean, obviously trading's picked up post-COVID. I think it's on about a P of about 18 times, revenue of about 82 million. I think profit and cash flow margins were being suppressed by the elevated R&D investment, and that's going to moderate over the medium to long term. It's generating 10% ARR growth, which highlights a relatively resilient business model. So it's winning new customers.
Yeah, and I think I know Christopher Mills likes it as well, which usually says a lot. If you're in good company, you can guarantee he's kicked the tires on it.
Exactly, you do tend to find that. Yeah. So yeah, we see some upside in that, and who knows? I mean, that could be a bid target.
Yeah. Yes, I agree. Yeah, with the US, I agree. Yeah, exactly. Yeah. Sort of a software guys. Yeah. Now, on the sort of the kicking the tires, I suppose, Dr. Martens. Now, when I was a lad, we used to have these as sort of like the, skinheads and thugs used to wear these, a bit like me.
Well, it's changed
now. It is, yes.
Exactly. My 16-year-old daughter, has got 2 pairs of Doc Martens. So yeah, it's a completely different market, isn't it? And
so that's what you do. Is that doing a bit of due diligence on the stock? Is it testing the boots out?
Well, that was my kid saying. But then I went to a party and I was surrounded, and I talked to one of the girls who was a photographer there, and they couldn't speak highly enough. And I think she owned 2 pairs, and she was like, literally, and she was telling me every design she had, and what more, which other one she wanted. I mean, they've come down a long way, Doc Martens. I mean, that's on a P of 12 times in 23. They've locked in factory pricing until June 23. Direct to consumers, 50% of the revenues. Look, it's going to be. I mean, I haven't got many consumer stocks in the portfolio, and this is with some shipping, supply, demand, blah blah. You could have, but it's I think a lot of the bad news is priced in that one. And
what made you select Doc Martens as a consumer stock compared to other sort of like consumer stocks?
We'd met the management. We were really impressed with them, and we just felt that it was it was the kind of thing, as we were saying, that the young, that demographic will carry on buying, because they see it as the kind of thing that they can buy for fashion, but also because they last for a long time. And as I say, it looked to us like the price had come down to a valuation that we'll look back in 2 or 3 years' time and think we were pretty smart buying it down there.
Yeah, I mean, it's an iconic brand around the world, isn't
Absolutely,
it? I think there's nothing like it, basically.
That's right.
You got Timberland, but they're 2 different types of boots.
Yeah, exactly.
Yeah. Now, just on a sort of like moving from what you've recently bought to sort of running your winners. I mean, there was one company that listed just over a year ago, Belluscura, which makes, I know it's a pioneering sort of early stage portable oxygen concentrator medical devices manufacturer.
Yeah, exactly. Oxygen enrichment technology.
That's correct.
That uses zeolites to rip out your the nitrogen, and that's it.
But I think the shares have doubled since the IPO, which is absolute a very unusual situation.
Well, that's right. I think it was the second best performing IPO last year, if memory serves. And as you say, they listed at 45 last year. And I think at their high, they probably got to about 140, 150. They just raised money at 85p, which was to help them with the non-reoccurring engineering cost for their deal there in the Far East. As you say, I mean, it's pretty blue sky. They've only sold 377 units this last year gone, but they expect to do 4,000 next year, and that ramps up to 18,000 in 2023. And one of their products, the Discover R, launches in Q4, and then you've got the portable one launches as well. So I think there should be plenty of news. I mean, the danger with that is as regards input costs, and buying all the materials in order to be able to do that. But I feel that they've managed to get themselves in a good position there.
I did notice also that the leader in the portable oxygen concentrator device market, Inogen, has been struggling with supply.
That's right. Yeah.
Which means that the demand for Belluscura's device is enormous. The problem is the challenge is going to be meeting the demand.
Well, that's just it, and that's the problem is making them and getting and meeting that demand.
Another one which has done really well is Beeks Financial Cloud, and they sort of do software or services for high frequency traders, and they put
that's it. Yeah, so they provide a cloud-based, ultra low latency connectivity, basically for the financial services industry, to sort of for the high speed trading. And we took part in the oversubscribed placing. I think they raised about 15 million earlier on this year, about 165. So we love supporting fundraisers where when they're raising capital to sort of significantly accelerate the near term growth. And I mean, Is it the cheapest thing in the world? Probably not. However, if you look at the statement in June, which is pretty, because after they'd raised the money, they just started. They won their first win for a top exchange, and they said they significantly believe the opportunity for exchange cloud to be potentially transformative for the business.
What is their USP? Because I'd have thought they'd be competing against all the big cloud operators, but obviously they've got industry dominance here.
Yeah, well, I think what you find is that all the big cloud operators, none of the hedge funds really want to use them to give away, to have all their information on there. So they'll use their bit of kit, and then they own the kit, and they've sort of kept it away from from the likes of Amazon. So yeah, it's a very unique position for them to be in.
Yeah. Another company that seems to be shooting the lights out, which came out with results this morning, is sort of B2B payments Forex business, Alpha FX. Now, they've got like 30-40% like-for-like growth. And I would say it's going like a train, but this is more of a sort of like a 300-mile-an-hour train. I don't think they've invented them yet, other than Alpha FX.
Yeah, well, we were very lucky. We got into Alpha FX for clients back in 2014. We took part in the IPO, and so we know Morgan Tilbrook very well. And funny enough, they're in the office today at lunchtime, and that's what's key, as you know as well as I do. That's what's really key about finding good businesses is meeting the management and spending time with everybody, kicking the tires. And that's what we do. I mean, we see average between sort of 60 and 65 companies a month, which gives us a huge wealth of knowledge. 60
to 65 a month, so that it's about 3 a day.
Yeah.
Wow, you work pretty long hours.
Yeah, we do. I mean, that's between. I mean, there's a few of us doing that. I mean, on the Dowgate Wealth team, there's 15 in the team. And there's at least 6 or 7 of those are investment managers. So there'll always be at least 1 or 2 in each meeting. Then we'll sit down each day and talk about what we've seen. But as you say, Alpha FX has been great. First half results this morning, revenue grew by 35%. Underlying PBT margin came in at 39%. And they've invested in both divisions. They've got 74 new heads in the period. And so I saw a note from Liberum this morning that they've upgraded their forecasts for 22 and 23. So
that's a run the winner job, isn't it? That's just keep on it. The business is flying. It could well be a takeover target at some point as well, possibly.
Yeah, well, I'm not sure Morgan would want to sell. I think he's on a bit of a mission. He's got a lot more work.
Oh, okay. He's got world domination.
I think so. I think what else would he want to do with his time?
Another one you've got on your portfolio that put out a nice little acquisition tuck-in is Ashtead Technology that I know Judith McKenzie at Downing has been sort of like talking about as well, which has a sort of like does submersibles and for offshore renewables and oil and gas services.
That's right. And I mean, it used to be part of the old Ashtead business, the big,
okay. Hence the name.
Yeah, exactly. And then I think Ashtead, I must have had to sell it when they got in trouble, whenever it was. Might have been in maybe it was 2000 or maybe 2008. I don't know. But anyway, they flipped it out. And I took part in the original IPO for clients, and then I bought when the fund launched. We bought some for the fund. It's 200 million market cap. I think PE held stock, and they recently sold stock at £2. And as you say, good numbers today. PBT was up 95%. EBITDA up 21%. Strong revenue growth across both divisions. As you say, there's renewables and oil and gas. Renewables up 26 and gas up 30.
That's only going to get stronger, isn't it? I mean, let's be clear about it. With the Russian sort of crisis, regardless of whether that settles, there's no way the West is going back to oil and gas.
We're not going back to oil and gas, yeah, and we'll find
not from Russia anyway.
No, exactly. And we'll find out what we'll find out at 12:30 today how Liz Truss is going to save the world, and as you say, it could well be that more spending on renewables. and she's going to have to do something to kind of ease.
And I think there'll be tax incentives as well at some point for explorers and for renewables and anything which is in that area, simply because we've got to encourage more development, both in transitional fuels, but more importantly, obviously, in the offshore wind, because that's one of our biggest assets that we are exploiting, probably the best in the world, but we just got to carry on doing it, because it's a way to get us out of this sort of sticky corner, isn't it?
Exactly. Yeah. So I think Ashtead's perfectly placed to do that. So.
Actually, your portfolio. You've had quite a few winners, because the other one I just would like to have a quick chat is, which I've never really covered, is JTC, which is sort of like all things services and technology for fund managers
for fund management. Yeah, and again, we saw that as relatively defensive. So that provides administration and services to institutional funds. Does 8 to 10% organic growth, which is done consistently since the IPO. Now, and it's interesting, 90% of the revenues are time costed or fixed fees. So the revenues aren't linked to the value of the assets, which I think most people probably don't necessarily understand. So, if people think if the market goes down, their assets revenue is going to go down. So our track record of accretive bolt-on M&A, which was a sort of key theme in 2021. It made 7 acquisitions. And EBITDA margins be in line with around between sort of 33 and 38%. So again, it's solid, it's growing, but it's defensive as well, because especially with the sort of the increasing sort of compliance requirement in the industry. Two you won't have seen where we did well as well. We had RPS on the bid.
Oh, I see. Yeah, which recently got taken over.
Yeah. So we were quite lucky. We had some RPS, and then we also had some HomeServe as well.
Okay. I think M&A is going to be a major theme going. Well, I mean, we've seen it recently with Micro.
That's why I mention it, and I think it's absolutely right, because we've already seen a lot of bids over the summer, and I can't see, certainly with Sterling where it is, why that won't continue. If you're a US company with deep pockets, and there's never been a better time to buy UK PLC.
Might be good for tourist locations for foreigners coming over as well. But I'm not sure how you're actually going to invest in that one. Another one which is doing very well, and you talked about sort of really good management teams, is Big Technologies with Sarah Murray, who I think is the founder and the CEO. And Darren Morris, who's come out, obviously the sort of finance area and worked as the CFO for Volex, and I think they do all things sort of like electronic tagging for prisoners coming out.
Isn't it? Yeah, exactly. It's electronic tagging for prisoners, but then also for for people in care homes, or people need looking after, or for asylum. 730 million market cap. P of about 33 times, but that goes down to 27 the next year. It's got cash on the balance sheet, about 65 million, I think. Good margins, and so I mean it's quite a unique asset, I think, don't you? I think I say, and again, I think we met them a couple of times, and we decided to press the button because I think it's quite an unusual thing to own.
Well, they seem to be generating. I mean, they've got huge margins, huge competitive advantage, generating shed loads. They're a category killer in all things electronic tagging, aren't they? With I think big positions in New Zealand and Australia. And
that's right. I think they've just won that big contract in New Zealand. Yeah, that's right.
Yeah. So good place to sort of like to park your money. Now, one area with that is perhaps a sort of like a bit more beaten down and perhaps a bit more sort of variable is I would have thought is OneSavingsBank, which is sort of like a lender to, is it buy to let, sort of like property owners and stuff?
That's right. Yeah. We've been talking about that one in our meetings, because obviously it's as you say, it's it looks like the housing market's starting to cool, isn't it? I saw something this morning, and as you say, buy to let.
Well, it should do from 10% per annum price growth.
Exactly, and that may well be what it needs, because you can't keep going, because that really will cause issues. But if there's a healthy pullback I mean, OneSavingsBank, they had upgrades of 12% this year. They're halfway through £100 million buyback. pays 30% of its earnings out as dividends, yields 4.6%. And I think it's on a P of about 6 times, isn't it? So obviously, yeah, I mean, you know, the bullish case is, you know, it looks, you know, it's not expensive. And, you know, I think Investec have got about, I think one of the brokers have got about an £8 target on it. But you know, your bear case is that, you know, the tenants, you know, get themselves in a mess and, you know, and sort of having stress, and then they start, you know, starts to be an issue. But I don't think we're at that point yet. But it's one that, you know, it's you know, we're certainly watching.
Yeah, I would say sort of like, you know, the as lenders go, sort of like the mortgage lenders, the Lloyds and the OneSavingsBank are probably the safest ones to go, because they've got secured debt. Whereas if you go more credit card or company commercial borrowing, that's probably where you're going to struggle a bit more. I don't know. Anyway, that'll be my take. Now, another one which is sort of like perhaps benefiting this one, which is to do with the cost of living crisis, is Telecom Plus, that I think offers a whole lot of sort of like domestic services to consumers and to households, and they put it all in. They don't advertise, and therefore they're sort of like, you know.
That's right. It's so they've got their brand is called Utility Warehouse. Have you signed up with them? Have you moved all your?
No, I haven't, not yet. No, but we're definitely sort of like looking for areas to save a few bob with, other than just turning the heating off.
Yeah. So I've not either, I'm ashamed to say. However, my colleagues who sit to my left and my right of me have both signed up with them, and said it was a very nice experience. They're saving a few quid. So, you know, I say it does work. We saw them recently, and so as you say, I mean, they're in a real sweet spot, aren't they? Because, you know, they sell their combined services, electricity, gas, telecoms, and insurance, and I think mobile and broadband. And so they you know, they pass on their savings to the customers with a sort of structural so they have a structural cost advantage. And I say they don't advertise, and they rely on their customers to be the salesman for them. And I saw that I think that they're expecting to add a million. They're expecting a million net customer adds by 2026. And if you imagine that they've only got 727,000 customers now, so we do think there's that's a decent platform for growth. But I mean, the shares did have a very good run, and I think there must be. I think they probably have a sort of sub £20 now.
They were just about 19 quid. I saw them last time.
Having been 22, I did take a little bit of profit when they got to 22. Because I just thought valuation wise they may have just, you know, done enough, but I might look to buy them.
I guess the only thing I could see that potentially needs to be watched is if the government in their measures for the cost of living decide to act.
This is why I took some profit when they were up there, because it is one of those you just don't know what our new Prime Minister might do. Just sort of think that they're trying to, you know, solve the problem, and then
they cause a bigger issue.
Well, that's just it. Yeah, it's happened before. Yeah.
And perhaps on the other side of the spectrum is another one, Watches of Switzerland, that essentially a big retailer, a very plush and gold-plated Rolexes and Omegas and all these kind of guys. And
well, that's I'm sure you've got 2 or 3 Rolexes.
Yeah, right. I've splashed out on my $999 Casio.
Yeah. So again, we saw watches when they IPO'd, and it must have been 2018 they originally IPO'd at just under 3 quid. And we saw them twice anyway, and we did that for clients. And I mean, they've done amazingly well. They've got 155 stores in the UK. They've got 7 stores in the US, and then which are their own brand, and they've got some various mono brand stores in the US as well. And I mean, the shares have come off a lot. I mean, they got to 16 quid at their high. They're probably sub 8 quid now. So valuation.
Yeah, they're about 750.
Yeah, so valuation has come down a long way. It's now on a P of about 14. I mean, do you think people are buying Rolexes are going to be affected by inflationary headwinds? Probably not. I mean, I think the share price has probably reacted the way it has because the second-hand market has cooled off quite a bit.
Right.
I don't know if you follow it or not, but I mean, you can effectively buy a Rolex for 10, and then the second-hand market they were trading at 16.
Yeah, okay.
So there was, but that has cooled down a little bit. But they're still trading at, the second hand is still trading at a significant premium to the to the new. And there's a huge waiting list for these things. So you go into watches and want to buy a Rolex, you're waiting 6 to 12 months to actually get one. And in the meantime, they'll probably encourage you to buy, a different brand, and in order to bump yourself up that waiting list. And Rolex put its prices up this last week as well. So you're going to have to pay another 5.5% more for your.
Oh, okay. Well, I definitely won't be going to that shop, that's for sure. But I would say such that. I mean, it does seem as though the top end consumer is pretty resilient and doesn't seem to be too affected by pricing. The only thing I would, in previous recessions, it's become sort of like socially unacceptable to splash out on sort of ostentatious items. Now, whether you'd class as sort of like a Rolex for display purposes, I don't know, but that'd be my only take, is such that people who can afford it don't buy, not because they haven't got enough cash, but simply because it's actually you rubbing people's noses in it.
Yeah, no, I understand that. But I'd say that they've not experienced that yet. They're still seeing it. They've had a really strong start to the year, and I think the figure is, I think sort of 75% of their sales are supply constrained. So people are still happy to go on these waiting lists for it. But
yeah. And another one which is sort of like should be relatively defensive is the old First Derivatives business, FD Technologies, that sort of like supply analytics and IT services and and data and all this sort of stuff.
Exactly. Real time
for the financial community, for your fund managers, your hedge funds, and big banks and people like that.
Yeah, and they've got to say their customers are sort of energy, automotive, manufacturing, and financial services. I think
seems to be some of the parts play. I know Richard Penny was very, very keen on it. And it went up with the big Microsoft contract, and then has come back down.
It has. There's been quite a bit of profit taking, hasn't there? And as you say, so they've become part of the Microsoft partner scheme, where they're doing they're going. Their KX is going onto Azure. We expect that. I think that gets completed in the first half of next year. And as you say, it's some of the parts, because if things really take off there, then that could be worth quite a significant part of the business. But margins are improving as well. I think at the low margins we're down to sort of around about 3%, and I think they'll probably be back at sort of 5.6% this year.
And what's the management team like? Have you spoken to them at all?
Yeah, we've met them a couple of times, and really solid.
Okay, good. I wouldn't be surprised if somebody comes knocking for those guys at some point in time. Private equity seems like a seems like a perfect play on bundling and with industry dominance in the finance vertical. Yeah,
that's definitely in our notes as to what definitely one of the reasons to own is that someone may come and have a look at it.
Yeah, okay. And now it's a couple of areas that are sort of like have been a bit in the sort of like the troubling spot, so to speak. They've been through a few headwinds. Is
on the naughty step. Yeah.
I wouldn't say naughty step, but we've got a few issues which they're resolving. First of all, is Hotel Chocolat, which is Angus Thirlwell's.
Yeah, and we've known Angus for years, again since the IPO, and they really shocked the market. When was it? I was on holiday, so it ruined my holiday. It must have been July. Because obviously they've been pushing out their expansion in Japan and the US.
Their Velvetizer, which is their hot chocolate machine.
Well, yeah. Have you got a Velvetizer? My kids.
No, I haven't. No, I haven't even got a coffee. But I've got a tea. I've got a kettle.
You've got a kettle. Okay, so you must have shares in Strix then. But no, Hotel Chocolat. My kid, we've got a Velvetizer, and my kids love it.
Oh, good. Okay.
But anyway, but they say Velvetizer is doing really well in the UK. They announced in July that they're going to pull back their expansions in Japan and the US, and so obviously that's really hit forecasts. And already the market, is obviously worried about higher cacao prices, living wages, raw material costs. We didn't have a huge position in it, fortunately, but then I did buy more on the bad news, because we thought that and I usually hate averaging down, but with that I thought that they'd kitchen sink the forecasts, and I think they've probably got that they'll do 10 million, and I think that's probably be a bit light. And if they can get back to sort of 20% EBITDA margins with a 3-year view, then the shares are on the shares are the wrong price.
Yeah, they look at about 10 times PER at the moment.
Yeah, that's right. Yeah, look, I mean, he's Angus owns a lot. Again, he's got a lot of his own personal wealth in the stock. So he's obviously didn't want to take any undue risks and overstretch themselves and then have to come back to the market to try and raise money.
Yeah,
so I think that's why he's done that.
Yeah, well, it's an iconic brand, isn't it? I mean, it may be not quite as big as Cadbury's, but Cadbury's did get taken out, didn't it, by Mondelez?
Yeah,
it's definitely got a worldwide status. So it's just going through a tough patch. And another one which actually with the shares are suspended is Revolution Beauty. That seems to, their products are sort of affordable quality cosmetics and hair care products and stuff that has done. I mean, basically, really that product set is really sort of chimed with the young consumer demographic. I mean, I know plenty of girls who use it. And in fact, even blokes who use it and stuff.
No, exactly. No, I agree. Exactly. You can't. You're not allowed to say things like that anymore. It's
no, I know. but unfortunately, they sort of missed their. Well, they didn't actually miss their targets. They got the targets, but they've had a few auditor issues, etc., and they've got to resolve those.
I think they had the auditor issues, and then they had it was the destocking, wasn't it? They basically said, anyway, we cut them.
Okay.
I mean, we cut them sort of in the sort of mid-20s.
Just recently.
Yeah. Again, I think that probably happened in late July when they first said that they were, anyway. So I'm a big, if something like that, I think that's the difference with Hotel Chocolat. I was happy to, to back them and buy more. But with Rev Beauty, I was, I think, I think it was going to be a hard push for them. So I said we sold them.
Yeah, and so just more broadly, then, where do you? I mean, you obviously sort of talked about a lot of how you decide what companies you're going to buy. How do you decide on which companies you're going to sell and take profits? And what's sort of your guiding principles?
It's on valuation. I mean, look, I used to work for Giles Hargreave, and if he said it once, he said it 1,000 times a day. You run your winners. Really great stocks are hard to come by. When you have them, you do. So you have to. It's key that you do that, and it's very key when you get something wrong, you cut it quite quickly. But say running those winners, and then you just, I'm a big, I say, and what he used to be very good at was taking profit along the way. When it had a big spike, you dribble a bit into the market to encourage the retail market, and then you can almost trade the position and move in and out. We sit down, we have meetings every day, me and myself and the team, looking at all the valuations and whether we think things have reached our price target yet, or if they have reached our price target, what's the next catalyst for are we missing is other upgrades in there that we're not pricing in.
Right. Okay, good. All right. Well, thanks very much, Mark. And just sort of like just before we finish, if somebody wants to invest in the fund, the Dowgate Wealth Fund, how best to do? Is it send you an email, or is it website, or how?
Yeah, so if people have got more questions, they can email me at mark.chadwick@dowgate.co.uk. Or they can go through the website, and there's a bit more information on the website, and they can click a link through there and get some more details, get the fact sheet on the fund.
Well, brilliant. Well, as I say, I think you've got a very good blend there of sort of like, growth, defensive, and hedging shares there, plus with a good solid cash balance going forward to pick up any sort of like fallen angels if they're around. So well done, Mark, and thanks very much.
Yeah, really appreciate it. Good to talk to you.